The global economy is no longer just a network of trade and finance, it's a battlefield. On April 9, 2025, the United States and China escalated their long-brewing conflict into a full-scale economic showdown, with the U.S. slapping a historic 145% tariff on Chinese imports and Beijing firing back with an 84% tariff on American goods. The world was jolted into a new reality. Markets tumbled, corporations scrambled, and the financial world braced for impact. But this isn't just about tariffs, it's about control of trade routes, currencies, technologies, and the balance of global power. At its core, this confrontation is not just reactive policy or national posturing, it's a carefully calculated shift, particularly by China, to break away from decades of dependency on the U.S. economy, and more specifically, on the U.S. dollar. Over the past 10 years, Beijing has taken deliberate steps to reduce its exposure to American financial instruments. It has sold off hundreds of billions in U.S. treasuries, expanded the reach of its central bank digital currency, and fortified trade partnerships that bypass traditional Western channels. The digital yuan, once dismissed as a state-run experiment, is now used in pilot programs and formal transactions across more than 30 countries. This trade war is not isolated, it reflects a broader geopolitical realignment. China's economic strategy is deeply tied to its national ambitions. The Chinese Communist Party sees economic resilience as the foundation for technological self-sufficiency and military strength. As U.S. export restrictions target semiconductors, AI hardware, and advanced manufacturing tools, China's response is not just tit-for-tat tariffs, it's structural realignment. Beijing is accelerating domestic innovation, investing heavily in its own semiconductor ecosystem, and promoting regional supply chains under Chinese influence. For the United States, the challenge is equally existential. The return of Donald Trump to the presidency in 2024 has brought back a hardline stance on China. His administration has framed the new wave of tariffs as a national security imperative, necessary to protect American jobs, industries, and innovation from what it calls China's state-sponsored economic aggression. Legislation passed in early 2025, such as the American Industrial Security Act, has poured billions into reshoring high-tech manufacturing, reviving the Rust Belt, and reducing reliance on Chinese components. But while these efforts play well politically, they are already producing collateral damage in the corporate world. Major U.S. exporters are suffering immediate losses. Tesla, once China's golden child in foreign investment, has suspended all shipments to the mainland. Semiconductor giants like Qualcomm, Intel, and AMD have seen billions wiped from their market capitalization as Beijing tightens its grip on advanced electronics imports. Deere & Company, which had heavily expanded into China's agricultural machinery market, has warned investors of nearly $4 billion in second-quarter losses. The Dow Jones plunged over 600 points in a single day following China's retaliation, with the Nasdaq showing signs of prolonged instability. Investor confidence has been deeply shaken. Even more concerning is the reaction of global markets. The trade war between the world's two largest economies is not just affecting bilateral commerce, it's disrupting entire supply chains that span dozens of countries. In Southeast Asia, nations like Vietnam, Malaysia, and Thailand, which function as critical nodes in U.S. China manufacturing flows, are facing bottlenecks, delays, and rising operational costs. European economies, especially Germany and Italy, are now navigating pressure to pick sides while trying to protect their industries from further contagion. The European Union, for its part, has issued cautious statements, advocating for de-escalation while preparing emergency subsidies for affected sectors. In the midst of all this, China is advancing another part of its long-term strategy, challenging the U.S. dollar's supremacy. The dollar has underpinned global trade for nearly a century, but Beijing is steadily undermining that foundation. The digital yuan is now integrated into cross-border payment systems in countries throughout Africa and the Middle East. In a landmark move, Turkey and Nigeria began settling oil contracts in yuan in early 2025. Iran, already under Western sanctions, has joined China's digital settlement network, effectively bypassing SWIFT and U.S. financial oversight. Moreover, the BRICS Plus coalition, now including Saudi Arabia, Argentina, Iran, and Egypt, has launched a new blockchain-based platform for cross-border payments. This system facilitates trade in local currencies, further eroding the necessity of the dollar in international transactions. According to the International Monetary Fund, more than 20% of global trade could bypass the dollar by 2027 if current trends continue. This isn't mere speculation, it's already happening. As dollar-based systems lose their grip, America's ability to enforce sanctions, control capital flows, and influence global finance will face a fundamental test. This decoupling is not simply an economic development, it's a geopolitical transformation. The institutions that once governed the rules of globalization, such as the World Trade Organization and the IMF, are struggling to adapt to this new multipolar order. The WTO has warned that prolonged fragmentation of global trade could cost the global economy up to 5% of GDP over the next decade. In practical terms, this means lower growth, slower innovation, and heightened geopolitical risk for nearly every country, not just the U.S. and China. For countries in the global south, these changes present both risk and opportunity. On one hand, they are increasingly being drawn into a world where choosing between American and Chinese systems becomes unavoidable. On the other hand, the shift toward regional trade agreements and currency diversification allows for more bargaining power and strategic autonomy. Latin America, for instance, is seeing a surge in bilateral trade agreements denominated in local currencies. African economies are experimenting with regional digital currencies and exploring alternatives to SWIFT. While governments and financial institutions race to adapt, the corporate world is in crisis mode. Multinational corporations that built global supply chains under the assumption of open markets and relative stability are now rewriting strategies from scratch. Risk mitigation, supply redundancy, and dual inventory strategies are back on the table. Boardrooms are being forced to choose whether to prioritize access to the U.S. consumer base or the Chinese market. In this bifurcating world, neutrality is becoming an illusion. The technology sector remains the most volatile battleground. The U.S. has blocked key exports of advanced chips to China, citing national security concerns. In response, China has ramped up investment in homegrown chip design, establishing sovereign chip initiatives in collaboration with state-owned enterprises and strategic partners from Russia and the Middle East. Chinese universities and tech firms are producing the next generation of AI models, quantum research, and integrated circuits, independently of Western input. Meanwhile, U.S. companies face restricted access to their largest overseas customer. All of this is unfolding against a backdrop of growing military competition, cyber espionage, and a wider contest for global influence. In 2025, both the U.S. and China announced parallel plans to begin mineral extraction missions on the moon, each asserting economic and scientific motives. The global race for supremacy now stretches from seabeds to outer space, further blurring the line between economic rivalry and geopolitical conflict. At a human level, workers, families, and communities are feeling the consequences. From soybean farmers in Iowa losing their biggest export market to Chinese factories laying off thousands due to canceled U.S. contracts, the pain is widespread. Inflationary pressures are building as import costs rise. Consumer prices, already strained by energy and food insecurity, are ticking upward across both economies. Financial markets are volatile, and global investor sentiment is increasingly cautious. Yet perhaps the most consequential element of this moment is ideological. The clash is not just about trade, it's about competing visions for how the world should be organized. One led by liberal democratic values, open markets, and Western alliances. The other by state-managed capitalism, regional influence zones, and a reimagined financial system less dependent on the West. This ideological divergence is becoming institutionalized, with both countries backing separate tech standards, financial systems, and military doctrines. What began as a trade dispute has become a referendum on the future of globalization itself. The once unquestioned idea that economic interdependence would prevent conflict has been replaced by the reality of weaponized trade, politicized currencies, and fractured alliances. The world is entering a new phase, one where resilience, sovereignty, and strategic independence are prioritized over efficiency and openness. The question now is whether the global system can withstand this reordering without sliding into deeper instability. Can multilateral institutions be reformed to manage conflict in a world of regional blocs and diverging norms? Can economies absorb the costs of decoupling without triggering recession? And perhaps most importantly, who will write the rules of the next global order? These are no longer theoretical debates, they are the defining questions of our time. And as the U.S. China rivalry plays out across continents, currencies, and code, the world watches, not just for who wins, but for what